Welcome to the Live Wealthy podcast with Dawn, where we are growing our wealth and our worth at the same time. You ready? Let's go. Welcome back to the Live Wealthy podcast with Dawn Delby. And today we are talking about where you should be investing your money. So many times people come to me and ask me, what should I be investing in, Dawn? Like what type of investment, stocks, bonds, alternatives? But more importantly than what is where you should be investing your money. And that is the first step to an investment process. So many people say, should I invest in crypto or should I invest in large companies and midsize and international and bonds and real estate, blah, 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 blah. The most important question is where, because what people don't realize is that taxes are likely your biggest expense. And taxes not only impact your income, which we all know, but taxes also impact your investments and where you invest your money and what I would say bucket of asset class and bucket of accounts you invest your money in matters more. So we want to talk about investing in where today. So, okay, where to invest your money. So I'm going to put a PDF in the notes so you can visually see this, but there are really only 3 different where you can invest your money in. Okay. So there are 3, I call them buckets. When I started as a financial advisor, back in the day, we had this thing called the tax control triangle. And so I want you to visualize this because I can't show you the tax control triangle right now, but you can pull it up in the show notes. But I want you to visualize a triangle. Okay, a triangle. And at the very peaks of the triangle, there's 2 at the bottom and 1 at the top. Those 3 peaks, the top, the left, and the right, are the 3 places of where you can invest your money. And so the bottom left corner is a taxable bucket. The bottom right corner is a tax deferred bucket. And at the top of the triangle is a tax-free bucket. I don't care how much money you don't have or how much money you have. There's only these 3 choices: taxable, tax deferred, and tax free. And the name of the game is to have tax balance in your investments. That matters first and foremost before what to invest in. So it's this tax balance. I like to say that people should have approximately 30% of their money in the taxable bucket. They should have approximately 40% of their money in the tax deferred bucket, and they should have about 30% of their money in the tax free bucket. Why do we want this balance? We want this balance because we all cannot predict the tax brackets of today and tomorrow. Now, I know we are in the lowest tax bracket environment we've been in over 40 years, and I don't necessarily believe that tax brackets are going to go up significantly, but because of all the government debt that we have, I do believe our taxes overall, maybe not the brackets, but the taxes and how you're taxed on everything is going to go up. Think about all of our taxes. Like we pay income tax, federal and state level. We pay sales tax on the things that we buy. So not only do we pay taxes on our income, but then we have to pay tax again on the things that we buy. We pay property taxes. Many of us pay payroll taxes. We pay, there's going to be a handful of us that have to pay estate taxes, which is again on the federal and state level. Like the taxes go on and on and on. So your Social Security tax, everything's taxed. So our brackets might not change, But how you're taxed and the government and the IRS makes it so difficult for you to understand the tax code that you think you're in like the 22 or the 24% tax bracket. But really what you don't understand is your taxes on your investments impact your overall taxes. It impacts your Social Security tax. It impacts how much Medicare premiums you're going to pay in the future, blah, 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 blah. So we have to play the tax game. That's why we need this tax control triangle. So there's these three places from an investment perspective, because your investments are also taxed. And there's the taxable bucket, there's the tax deferred bucket, and the tax-free bucket. So 30% and taxable. So what goes in this taxable bucket? Well, for many of you, it's your regular savings account, your brokerage, your investments that aren't tied to a retirement plan. It's your real estate, like any investments you hold that there's no penalty to get access to, but it's money that you hold in kind of a liquid accessibility. There's accessibility to these investments in this taxable account. So what happens is when you invest in a taxable account, a brokerage account, a savings account, real estate, is you put into, you're using your after-tax dollars. You receive your income and your tax on that income. And then after that money, your income has been taxed, you invest in these products, these investments, real estate, brokerage accounts, savings accounts. Okay. And what happens then is you also pay what's called capital gain tax on the gain. And if you hold that asset less than 12 months, you pay your regular tax bracket. You pay taxes at the level of your tax bracket. So if you're in the 22% tax bracket and you hold that investment, maybe you buy it in January and you sell it in June, and you haven't held it there for 12 months, then you're going to pay ordinary income tax. So whatever your ordinary income tax bracket is, that's the tax you're going to pay on any gain on that account. If you hold that investment for more than 12 months, then you pay long-term capital gains. So there's long-term and short-term capital gains. Okay. So if you hold it for 18 months, then you pay long-term capital gains, and long-term capital gains are taxed at anywhere from 0 up to 20%. So for example, if you are single and you file your taxes single and your taxable income is less than $47,000, you'll pay 0% on that capital gain, on that investment. If you are married filing joint taxes, if your taxable income is $94,000, then you're going to still only pay, or less than $94,000, you're going to pay 0% capital gain. However, if you are filing your taxes as a single individual and your taxable income is somewhere from $47,000 up to $518,000, you'll pay 15% on that long-term capital gain. If you're married filing joint, if your taxable income is $94,000 up to $583,000, these numbers are for 2024. Again, you'll pay 15% capital gain. The point is you're going to have to pay. It's a taxable bucket of money where you should have 30% of your assets there, but you are going to pay capital gain. It's either going to be 0, which most of the times, it's not 0. It's going to be somewhere between 15 and 20%. Or tax at your ordinary income bracket, which is probably higher than that. Okay. So that's the taxable bucket, 30%. Then on the bottom right-hand corner, which is the left, if you are watching this, if you're watching the podcast show, is the tax-deferred bucket. And inside of the tax-deferred bucket, these are accounts that are like your retirement plans through work. You might have a 401k, a 403b, a 457 plan, your IRAs, okay, your SEP IRAs, your simple IRAs, your I-401ks, anything that's a retirement account. And typically retirement accounts, how it works is that when you put money into the tax deferred bucket, just as it's called, tax deferred, that money is you save tax dollars today. So when you contribute into one of those accounts that I just mentioned, you are saving tax dollars. So for every $100 you're putting in, depending upon your tax bracket, you might be saving $30 in taxes. Okay. So you get the tax break today. But what happens is you typically have to hold that money in there, and it grows tax deferred. And you have to hold that money in there until you're 59 and a half. And then when you pull money out, it becomes 100% taxable because you never paid the taxes on the money going in. So if you put in $10,000 and it grows to $100,000 over 20 years, 30 years, 40 years, you'll pay taxes on all of the money coming out. And I typically like to see 40% of your contributions going in and 40% of the balance of assets that you have in that tax deferred bucket. Okay. Then at the top of the triangle, you like my hat, by the way? The Good Life by my friend Brooke, her brand. You should check out Brooke Hemingway and her brand. But at the top of the bucket, which is the top of my head right now, it's the tax-free bucket. Inside of the tax-free bucket are Roth IRAs, some municipal bonds, some life insurance, permanent life insurance policies. And I like to see about 30% of people's assets and contributions in to their investment portfolio in this tax-free bucket. So the tax-free bucket, again, when you put money in today, and by the way, you have to be able to qualify for the Roth IRA. If your income's too high, then you don't qualify for the Roth, but you put your tax dollars into a Roth, into a insurance policy, or into some municipal bonds. You put after tax dollars in there. So you're not getting a tax break or a tax write-off today by doing this. But what happens, that money grows tax free, and then you pull it out 100% tax free in the future. If you put in $10,000 today and it grows to $100,000 in the future, you pull out that $100,000 and pay zero taxes on there. Okay. So what is the right plan for you? Taxable, tax deferred, tax free. It's all of the things. It's all of the buckets, because we don't know where taxes are going to land. You don't want all your money in taxable. You don't want all your money in real estate. You don't want all your money sitting in the taxable bucket, because it's very expensive to pay capital gain tax or try to avoid capital gain taxes. You're eventually going to pay that capital gain tax. You don't want it all in your tax deferred bucket, because so many times our parents did that. They saved all their money in their retirement plans at work, and they think they're going to be, and they did that to save their tax dollars while they were working. And then they're in retirement. They think they're going to be in a lower tax bracket, and they're not. And I hear it all the time, because the government and the IRS are making it so difficult on how, all the other taxes that they're assessing everywhere else. There's AMT tax. I mean, there's all kinds of tax. And then the tax-free bucket, people think like they need to get all their money in the tax-free bucket. But, if you're making good income today, then you either don't qualify for it. Maybe you don't have a Roth 401k at work, and you can only get so much money in there. But you also need a tax break today, because taxes are expensive, right? It's our biggest expense. So regardless, because we can't predict, it's so important to consider where to invest your money: taxable, tax deferred, tax free. And then under those umbrellas or those buckets of money, then it's what to invest your money in. So if you're investing, if you want to invest in certain asset classes that are pay a dividend, you might not want to hold them in the taxable bucket, because dividend income is typically taxed at ordinary income, right? So you want to hold maybe your dividend assets in a tax deferred place. Maybe you want to hold your really growthy non-dividend assets in your taxable account, because you don't have to pay the dividend tax. Or you put some of your more conservative assets in that taxable account, because that is the account, the bucket of money where it has more flexibility and freedom. And if you get into a situation where you need to pull money from your investments, and you will get into that situation, pretty much can guarantee that, is that you'll have an account where it's flexible and it's not super aggressive, and you have your conservative assets sitting in a taxable account, because those conservative assets don't fluctuate as much. And you should never, ever, 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 ever pull money out of an investment that's at a loss. You never sell an investment at a loss and take it out and put it in as cash, and take it out and spend it or put it in cash. Okay. That's a no, 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 no. So you put more of your conservative investments in the taxable account. You put your tax-free. Like when money grows tax-free, that's where your super aggressive, very risky venture capital, crypto, like those type of investments should go in your tax-free bucket. And you guys, if you understand the tax game, not just from an income perspective, but that's a big game itself, but also from an investment perspective, you are going to put more money in your pocket. So before you start to invest your money, please consider where, which is which bucket, and then what to invest in is more important after you are deciding which bucket to invest in, because the buckets matter. Your tax brackets matter today. I guarantee you in retirement, you're going to wish you were in a lower tax bracket, and you probably won't be. And so it's all about keeping a consistent, steady tax bracket throughout your life, because consistency wins. That's how you get more money in your pocket. If you are looking to have a second opinion about your taxable investment strategy and want myself and my team to take a look at that, I'm more than happy to fill out the financial assessment in the link here below, and fill out the assessment, and we will give you some advice on what it's costing you from a tax perspective and how we could give you a better investment strategy to put more money back in your pocket so you can live for today and plan for tomorrow.